You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com. Welcome to the show.
Good to be back again, Jim.
You were talking about the slogan for the SAS, the British Commando Unit, known for its daring feats, and you think if you're an investor, you might want to follow their slogan, which is very simple: who dares wins. Maybe you can explain, David.
I've always been inspired by the Special Air Service and the SBS, the Special Boat Service, and these guys have been and done, and I love that who dares wins, and I think it's very appropriate for where we are now in this precious metals market where fear reigns, where we've seen declines going on in some cases for almost 2 years for many of these mining companies. We've seen dire reports of lower prices ahead for gold, silver, platinum, and palladium. And I think for anyone who still believes in the bull, as I do, as opposed to the baloney, that it's time to pull up our suspenders and get back to work. And so Who Dares Wins inspires me to start doing my research and get ready to act.
So you were saying it's good to have strategies whenever you're investing. You had instead of a 12-step plan, which is usually to get off something, you have a 6-step plan to get into investing.
I do. 6 steps, and I think that this will provide a comprehensive way to approach the situation. It's certainly the way I'm doing it. First of all, you need to check your big picture. And if someone who's listening believes that the bull market is over in the metals and that that's that, and we're not going to ever come back up again to any extent, let alone make new highs, then what we have to say that follows here will have very little meaning for them. But I personally don't believe that. I believe that the bull market will resume itself just like it did in the late 70s. I believe we'll go on to new all-time highs in gold and silver. I don't know what those highs will be, but I believe they'll be much higher than we've seen historically in a nominal and eventually in an inflation-adjusted price. So if you believe that this is, as I do, that the big picture is still in play for these metals, then you would go ahead to step 2. In step 2, you say bye-bye to bow wows. If you've got dogs in your portfolio, you look at those, and if they're dogs, you get rid of them. I don't care if you're down 90% and you can only get a relative few dollars to put somewhere else. Ask yourself, do I think this bow wow is ever going to hunt? And if it isn't, you get rid of it and you buy one that you believe will hunt. And that way you strengthen your portfolio, you get rid of that big red mark on your portfolio, and you put that money, even if it's just a little bit, back into action when you get ready to buy a company that you think is going to return to favor and is going to give you the rewards that you're going to seek for taking that kind of a risk.
Does their historic record count, or do you have to look at what they're doing today to deal with high costs and low returns?
Both of those things are important. The historical record gives you an idea of where it's been and how it's performed. For example, I look back at 2008 and 2009 and see how some of my choices did then. There's one particular silver producer in China that I noticed just the other day. It declined for 8 months in a row during the 2008 meltdown, 8 consecutive months. And I thought, what's interesting now, I looked at it, what's going on now, it's declined for 8 consecutive months this time around as well, too. And it makes me wonder, because then it went on to quadruple in price after that decline. I don't know if we'll see another couple months decline. Who knows? But this could be it. But definitely, it's showing the same kind of pattern, and it did not blow away, and it went on to become very profitable for shareholders and for the management alike. So that is important to look at that history. But now, given where we are with so many companies on the edge of blowing away, what you just said about looking at what's going on now is absolutely critical. Because some of these companies that did well before, they've changed their management structure, they've spent too much, they've done all sorts of things. Some of the biggest ones in the world have made some very serious systemic mistakes to their bottom line in the last few years since 2009. You want ones that are still doing the right thing, learning from their mistakes, and moving on to greater strengths in terms of production costs, in terms of more resources, this type of thing.
I know we don't usually like to name names, but when you were saying companies have been spending a lot of money on projects that may or may not work out, Barrick Gold and $4 billion invested on the Chilean-Argentinian border, and now a mine there shut down by the courts.
This is true, and they've had issues in other areas, and it just shows you that bigger isn't always better. Barrick has been in the news a lot lately, and probably will be more so before. They are either the largest gold mining company or the second largest. I believe they're still the largest, but they certainly have the largest issues right now. So what I like to do is look at the intermediate space, the so-called junior producers and the junior streamers. So it's okay to have some of the biggest in your portfolio, but more than likely the intermediates that are doing a good job, that are semi under the radar, that have strong management, good projects, good production profiles, and a good following in terms of shareholders, those are the ones that I think will return a greater percentage profit for the risk that you and I are going to take.
I know we're going to go through the 6 steps here. We're only on step number 2. But when you said take a look at the company and what they're all about, if you have a chance, meet the upper management, as you were saying with some of the smaller companies, they want you to come down and chat with them just so you're confident with them. There's now even a website, Meet the CEO, where you can, see them talk and give speeches and maybe get a feeling for them. Or is it still better to meet them in person and ask your own questions?
Both of those things are very important. There's another website, another Canadian website that I just love, and I believe it's called CEO.ca. And some of the very best and brightest minds in the resource sector are interviewed there. I go over there frequently. I just love it. It has a white background. Very highly recommended. Also, coming up this week, we're going to have the VRIC, the Vancouver Resource Investment Conference, put on by Cambridge House up in Vancouver. It's going to be Sunday, Monday, the 26, 27. And I'm going to be there. David Morgan's going to be there. He's going to be a keynoter. I'm going to be introducing presenters in one of the speaker halls. I'm going to be talking to mining companies, execs in the booths. And this is a great opportunity, especially since the attendance may be down a little because a lot of people are spaced out about what's going on. This is an opportunity to get up and close and personal to some of the very best people in the business and learn from them. And there are several companies that I'm targeting for either adding to my position or taking a new position, and I'm going to meet these people, talk to them, see what's going on, get a sense of the energy that they've got, and see if I want to deploy some of my capital into their companies.
Yes, we all plan to be at the Cambridge House meeting, and people should remember, too, it's free. Just pre-register, but just because you're pre-registered doesn't mean you just walk in through the door. I remember the last conference we were at, David, at the Vancouver Convention Center. It still took you half an hour, 45 minutes, to get processed. They have to give you your little neck tag and, your little bag of swag and all that stuff before you get into the conference hall. So just because you want to see somebody speak at 9 o'clock, don't expect that you can get in at 9 o'clock. I would suggest getting there, well before, the set time for your speaker. Anyway, so now we've got 2 steps. Check your big picture and say goodbye to the dogs in your portfolio. What are the next 4 steps we should be looking at?
Well, actually, we pretty well discussed the third step, which is planning your work and working through these filters that you have. You want strong management, a good share structure. You want to know that the company has some staying power, either they got a large benefactor that has bought some of their shares, another company, or a rich benefactor. And you want them to have a compelling project, not just some pie-in-the-sky idea that, well, maybe something's there. Then you go to the 4th step, which I target after we've done some of the producers, because that's the core of what you have, the intermediate producers. I like to look for a few exploration plays that I call have unique selling propositions, which is a copywriting term. And I ask these people, I come right out and I say, what is your unique selling proposition? What sets you apart from your colleagues in this space? Why should I buy your company? Because it is unique in what you do or what you have or what you're going to do. And if they could articulate that to me without even thinking, that gives me a lot of confidence that they know what they're about. It has to make sense to me, too. It might make sense to them, but I don't like it. But if I do, then I'm going to really be excited about looking further into that company's prospects. And so I always look at this as something that is really a consideration. There's a company that I've held off and on for several years, an Argentinian exploration play. And Argentina, of course, has very high country risk now because of the unstable economic policies they're pursuing. But I had looked back in my records this morning, and I have bought and sold that company 3 or 4 times from about $1.80 all the way down to where it is now at 8 cents a share. And so a couple times I've made a little bit of money, and a couple times I've lost a little bit of money. So I'm probably about break even for my whole campaign over the last 3-4 years. But I looked at it today, and it was 75% below where my last sale was on it. And I did the research, I looked into it, I talked to management, and I thought about this because I know that it could still be quite a while before things get better in Argentina. But I asked myself, is this the company, if I was going to hold one unique selling proposition play exploration company that probably a lot of other people haven't noticed so much in that country, which would it be if I was going to do it? And I realized that that's the one I would hold. So I reinstated my position this morning. Of course, I could buy a much larger one than I did originally, having sold a little higher. And if it drops another 50%, I'll double my position. But no matter how sure I am, and this takes us back up to the fifth step, actually, and into the sixth step, no matter how sure I am about this company, I'm not going to put all the money that I want to have into it in one spot. I'm going to wait and see if I can get some cheaper. Maybe I can't, in which case I'll have a good core position. But if I can, I'll be rooting for lower prices. I'll go in and I'll pick up those extra shares if I get the chance.
Do not go all in.
Go in tranches. This is psychologically important. It's good money management, and it will help you weather, because we could still have several more months of weakness here. And this takes me to the sixth step, the last one, which is really important. It's what I call the end times for the TSX scenario. We're already starting to hear that, the TSX might blow away as an exchange, A lot of these companies are going to blow away, especially the exploration companies that have no money. But we're always going to need to dig stuff out of the ground. Canada is always going to be in the forefront of exploration and production for the mining and the metals. We're not going to ever not need these metals, the copper, the silver, the gold, the palladium and platinum, the zinc, the lead. And these companies, the Canadian companies and explorers, are going to be the ones that are going to drive this forward. And so the TSX is not going to blow away. And what you and I need to do, if we're going to stay in this game, is to have mostly companies in our portfolio that are going to be survivors. And that's why we keep some mad money for prices that are so incredibly cheap that we can't believe they'd ever happen. But they happened in 2008, and they still could happen this year.
I've heard talk on the business television networks that some people are saying gold prices may fall to the cost of production. Is that a realistic scenario?
Well, the cost of production for some companies is hundreds of dollars of where it is now. So, you have to define what that is, whether it's all in production, this type of a thing. But gold prices could very well fall farther. But the point is, you're going to separate out the dogs from the producers, and the ones that can hunt are going to be the ones that you want to have. And I like a comment that Rick Rule made recently. I think it's really, really good, and it really inspires me. He says, sometimes about once every 10 years, you get to a place when mining company prices where you can buy good management for the same price as bad management. And that's exactly what we've got going on now. We have companies across the board that have been hammered almost into oblivion. It doesn't matter who the management is. It doesn't matter how much cash in the bank, how much they're producing. They're getting hammered. And so now we have a unique opportunity to search out those good management pieces, those great stories, and deploy our capital in them and have the patience to wait. And Rick Rule says every time he's done this, his net worth is increased by 5 times over the next 3 to 5 years. And I personally believe that we're going to see the same thing again. I believe he's right, and this is what I'm going to try to do. And it's not easy. It's hard. It was hard for me to buy today. I bought 2 companies today that I've held before. And I'm going to buy more of them if they go lower. It was not easy, but I know from reading the great people that inspire me, like Jim Sinclair, Rick Rule, Eric Sprott, David Morgan, these type of people, I know that it's the right thing for me to do. And our listeners are going to have to decide if it's the right thing for them.
I'll be seeing you at the Cambridge House Conference here in Vancouver, Sunday, Monday, and thousands of others. And hopefully they've all been listening and paying attention, because we're going to have some new information from there as well. Thanks a lot. Thanks for chatting with us, David. Our guest has been David Smith. He's the senior analyst for the Morgan Report, and you'll get to hear Mr. Morgan in person in Vancouver, Sunday and Monday. You can find their website at silver-investor.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. You can contact us at info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.